Alright, welcome to the recorded lecture all about capital expenditure. Our objectives on this recorded lecture will be for us to know what property, plant, and equipment is, determine the cost of the property, plant, and equipment, differentiate capital expenditures from revenue expenditures, recording of purchase of property, plant, and equipment, and then defining impairments and revaluations. Okay, so property, plant, and equipment, or PPE, are assets that having physical substance. So which means you can see them and touch them or feel them. And it is used for the operation for more than one period, particularly 1 year, okay, more than a year. And there is no intention of selling it to customers. There are other names for this term. They call it tangible assets, property and equipment, fixed assets, etc. The acquisition of PPE assets is critical to the success of nearly all entities. It is because these are the resources or tangible resources that the company is using in their operation. Now, in determining the cost of PPE, we have to determine, of course, what particular accounting principle is being applied to this one. So, the main accounting principle applied to this one is the cost principle. So, in cost principle, the cost of the or the amount that we purchase. The property, plant, and equipment is basically that will be the recorded cost. We call it fair value of that asset for that particular time, including other considerations, okay, to acquire an asset. So, for example, if you're buying an equipment and it requires you to pay some taxes before you will be able to use it, or some custom duties that you need to pay, as well as some installation activities that you need to perform to ensure that the property will be working as intended, then you have to include that as part of the cost. Now, as per accounting standards, the fair value is the price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. Now, we have to determine first the types of expenditures. So, this is important because we have to determine whether the expenditure that we had incurred will be capitalized or will be expensed. So the first type of expenditure, we call it capital expenditure. When you say capital expenditure, this expenditure increases the asset's capacity or capabilities or efficiency, or it extended its useful life. While revenue expenditure are expenditures that we incurred, which obviously do not extend the asset's capacity but just merely maintaining the asset's operation. Okay, in determining which cost to increase the asset account and which cost not to include is very important because it will add up to the asset, and basically it will be expense, uh, or all the expenses will be allocated in periods. While if it is charged as expense or revenue expenditure, it will be outright expense. Because if you don't distinguish it properly, it will affect the profit or loss statement. As I mentioned a while ago, if it is capitalized, the expensing of that portion will be allocated through periods of time. While if it is outright expense, automatically it will have a huge effect or significant effect on profit or loss statement. And then after the initial recognition, the entity may either use the cost method or revaluation method. A separate discussion on that will be seen in one of my recorded lectures. Now, to illustrate, assume that Hayes Manufacturing Limited acquires real estate at a cash cost of $100,000. The property contains an old warehouse that is demolished at a net cost of $6,000. So initially it has 7,500 cost less the savings or proceeds of $1,500. Additional expenditure are for solicitor's fee and stamp duty worth $2,000. As you notice in this illustration, the initial cost or the cash cost for the asset is $100,000. But we need to incur certain expenses, especially the solicitor's fee and stamp duty, because if we don't, the property will not be transferred to us. Now, you got an old warehouse where it was demolished, and you had actually saved something from that demolished warehouse. So it works like a deduction of the total cost of the asset because, again, as I mentioned, it is a saving for when you acquire this property. So the calculation would be like this. So we have cash price of the property, $100,000. Net removal cost of warehouse, $6,000. Solicitor's fee, $1,000. And then stamp duty, $2,000. Now, for subsequent expenditures, we have two types or major classification of expenditure. The first one is ordinary repairs, which incurred just to maintain the property's operation. So it is immaterial, so we don't usually charge that to the asset, but rather we are actually incurring or recognizing expense. While additions and improvements, these are costs that increases the operating efficiency, productivity capacity, or expected useful life of the property, plant, and equipment. And it is a material amount and should be capitalized. When you say capitalize, the cost of these additions and improvements will be added to the cost recorded for the property, plant, and equipment. Now, impairment. So, what is impairment? Uh, in a much simpler way to explain that, we had purchased assets and we expected assets to provide us with certain benefits. And of course, we have to factor in the cost of usage and the wear and tear of that asset. That's why we have depreciation. But in the case where unusual drop on the usefulness of the asset, or shall we say the usual or the drop in the benefits that we are receiving from the asset, then we may have to recognize what we call impairment, okay, or impairment loss. So it says here impairment loss is the amount by which the carrying amount of an asset or cash generating unit exceeds recoverable amount. So in this case, we're trying to figure out, okay, what will be the expected future cash flows for this asset? Will that be enough or will that be same with or shall we say more than our uh, recorded carrying amount? Or this expected future cash flows at present value is lesser than the carrying amount of the property, plant, and equipment. So in that case, if the present value of expected future cash flow is lower than the carrying amount, then we have to recognize impairment loss. Revaluation, on the other hand, is quite different. This is talks about the fair value of net asset. Now, after initial recognition of PPE, you have opted to use revaluation as your basis of presenting your property, plant, and equipment in annual report. Then you will use revaluation constantly or periodically every year. You have to measure the fair value of the asset. If there will be increase in fair value, we call it revaluation increase. So which means the carrying amount of the asset will increase also. If the revaluation value of the property decreases, then we have revaluation decrease. All right, thank you very much for watching the recorded video. Hope you learned something.